Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market 5. I'm your co-host, Joel Alcana, along with Brianna Valesky, and we have Chris Martenson on the line. He's an economic researcher and futurist. Chris, how you doing this morning?
Joel, I'm doing well. How about you?
Good. Thanks for coming on. I know I always ask you this, but you describe yourself as a futurist. So you gonna predict what's going on in the future?
Actually, what I do is I mostly just extrapolate trends, Joel. We're just looking at the direction things are going and trust that unless something changes, that's where we're headed.
Well, that's exactly what we want to talk about with you here. The broad market. Let's go to the broad market, the S&P 500 index. I mean, you call it a trading range. It is a trading range. But spending more time up at the upper end of the trading range here in the S&P 500 futures. Just from your research, what are you looking at in the market?
Well, this market is explained mostly by liquidity flows and expectations around what the central banks are going to or going to not do. Fundamentals have taken a back seat at this point in time by a lot of those measures, obviously. We're looking at a very extended market that's literally priced to perfection in some cases. So, I think that this market has less upside than downside built into it at this point from a risk standpoint. But again, it's really looking at liquidity flows more than anything else at this point.
All right, and the big elephant in the room has been Greece here, and boy, I mean, I almost like quit following it because it just coin flip. It goes back and forth so much. But you think something's going to happen this weekend?
Well, I stopped following it for a while too because it was rumors floated, unfloated, refloated, and on and on. It looks like we're down to the wire this weekend. We've got Angela Merkel very firmly boxed in a corner, at least from her own side politically, that they need to get out of this weekend with some sort of an agreement. But Tsipras is really, it is a coin flip. Nobody can read him. Is he going to knuckle under to the banking demands of the IMF and the EU? Or is he going to throw all of that under the bus and basically honor what his party, his own party, is very forcefully asking him to do, which is to enter default and accept the chaos that ensues from that? There are really no good options for Greece at this point in time. Very tough position for Tsipras to be in. But this is where we get back to the markets. I am a little surprised to see the markets basically floating along, given that this is a coin flip. Nobody knows which way Tsipras will go. If he decides to flip it to default, this is going to have some real market roiling activity associated with it. I don't see that in the markets yet.
You know what? I mean, it's just don't they have like 30% of their workforce, unemployment, and people retire at 55? I mean, if it, some of the stuff I've read, I mean, isn't that part of the situation over there that no one's working and everyone wants to retire early?
Well, that's part of it, but that's what got them here. And I don't think you can lay all of that at the feet of Tsipras, who's been in power for what, less than a year. So what we have in Greece is a situation where no matter how you go about the austerity program at this point in time, do you want to take away retiree benefits? Do you want to increase the VAT tax? Do you want to increase general tax and collection activities? What would you like to do? All of those activities fundamentally are going to put a torpedo right into the hull of the Greek economy. And so, obviously, unless Greece can grow its way out of its debt program, it's not going to get out of it, and it can't pay its way back out of this for a variety of reasons. So it's really stuck between a rock and a hard place in terms of the demands. It's this simple, Joel. Too much debt was issued. Somebody's going to have to take a haircut. That's always been what the debate is about. Who's going to eat the losses?
But didn't we already do this with them? I mean, is it just like a replay of a few years ago? Same situation.
It is actually, and this should have all happened and gone down in 2011 when it first surfaced. And so they've kicked the can down the road. What has happened is that both the ECB and the EFSF have vacuumed up a lot of the Greek debt away from the private holders. These were the banks in France and Germany in particular that were holding Greek debt, and then put this into the stabilization fund and onto the ECB balance sheet, where presumably they're a little safer. At least they won't drag a major bank down and create a domino effect. if the default happens and those bonds go bad. But this is Europe. It's very political. Somebody still has to eat those losses. They've been transferred to the taxpayers. So now in the exchange stabilization fund, every participating country has a pro rata share in those. And just to make this an obvious point, Spain would be on the hook for about 50 billion euros of the Greek debt that's on that stabilization fund. Spain does not have that money. So then the can gets kicked out of Greece, but firmly lands in Spain and other countries.
Yeah,
The question is then what?
the domino effect. I mean, they don't want to give in to the demands of the ECB and the austerity. And if they go solo, I mean, who's gonna take a drachma? I mean, who would deal in that currency if they've already turned their back on so much debt, and now they want? I mean, it just seems to me like they need to get bought by somebody, and they need a merger or something. And I know Russia's been kicking around with that, but they're certainly in no position to do that.
Well, they're not, but they would make some overtures. And to put this all in context, it's not it's not a huge amount of money that we're talking about here in the scheme of things. Central banks print money out of thin air. It's really not a huge amount. So I will be a little bit surprised if the European leadership doesn't finally knuckle under when all is said and done, rather than risk what would happen allowing this particular Greek pin to poke at what we all know is a very large debt bubble that's been accumulating in Europe for a very long time.
Okay, let's move on to the oil market. I know you do a lot of research on that, and crude is taking it under the chin today here, back under $59. Seem to be hugging the $60 level. I know there's been some talks, Saudi Arabia and Russia talking things up here, but what are you looking at? What are you looking at in the crude market? And let's look at the fundamentals.
Well, crude is a fundamental market. That's why I love it. It usually ends up making sense. Crude is right now oversupplied on the world market. We're seeing near record output from Russia, record outputs, at least in recent history, from Saudi Arabia. Those are the two major exporters by far. They're number one, number two. Everybody else is a distant three, four, five. And so what we're seeing is continued oversupply into markets. We're looking at China slowing down pretty aggressively if we're reading the commodity import data correctly. So there's not a lot of demand to soak up this extra oil. U.S. supplies have come down a bit more than the EIA is saying, but not enough yet to really put a dent in the overall supply equation. So we're looking at a market that's about as oversupplied as it has been in a long time. In another month or two, it will actually set a record. So it's an oversupplied market, and that's going to weigh on prices a bit. I think we're seeing additional speculative plays in the oil market right now, but fundamentals, if we're not careful, will be coming back to put more downward pressure on prices unless demand picks up or somebody bites the bullet and cuts supply.
Which doesn't seem like anyone's willing to do at this point. I mean, especially for Saudi Arabia and the Middle Eastern companies, their cost of production is so much lower than some of these refineries, U.S. refineries. What about some of these fracking companies here? Are they starting to feel the pinch? I think one of our guests earlier in the week was talking about, if there wasn't for like merger and acquisition talks of some of these frackers, they might be going bye bye.
Well, many of them should at this point in time. And the market there is still well supplied with liquidity. Wall Street and other investors are still throwing money at the patch. They need to start being a little more careful than they have been. So let's take it from the outside. Across the industry, there's $235 billion of debt sitting in the shale operators at this point in time. Even if you took $50 a barrel, which they are not realizing at the wellhead, they're getting less than that, but I'll make a round number to make the point. Even if they got $50 a barrel, it means that somewhere around 4.7 billion barrels of oil is already spoken for just by the debt. Now, what about equity owners? Wouldn't they like to get a piece of the pie? It means that a serious proportion of the overall production that's going to come out of these players for the next, pick a number, 5, 6 years, is pretty well all spoken for just by the debt, and they're having no trouble, Joel, rolling into the market and getting more debt. So I don't know what the market's thinking at this point, but they should really start adding up the numbers because that's a pretty big disconnect right now.
And what are some of the frackers, some of the stocks that you're talking about here that have that extraordinary debt?
Well, this is pretty easy numbers to figure out and run. We've got just companies in there, in particular that I'm looking at. Whiting
What's the
has
symbol on
just
that?
got WLL, and
Okay.
it's just an extraordinary amount of debt on the books of that. They had a huge acquisition with Kodiak, where they vacuumed up an amount of debt. When I look at that company now, and I look at the amount of debt they've got, and I look at their current amount of oil that's coming out of the ground on a daily basis, you can divide those two numbers by and include the price of oil, and just the debt alone on that company cannot be paid back under current terms. So people investing in that company are counting on oil price going higher from here. That's a bet. It's not an investment because of the fundamentals of the oil market right now.
Well, I wish I'd been talking to you about this stock 4 or 5 months ago. The thing was at $90 and has come
Yeah.
back all the way into 35 here and just consolidating here. Who knows what the next move will be? Any other companies that are carrying this extremely high debt? Maybe one that hasn't taken such a tumble that maybe might be something to look at as a potential short or potential put investment.
Well, I don't have that off the top of my head. I have a
Okay.
whole list of them that I am tracking. Many of them have already taken a hit, but I will tell you that it is that coin flip right now for a lot of people where they are. You're watching the consolidation at these levels. These are not the potential lows. If oil goes down instead of up, we're going to have to watch that. And I would advise everybody it's time to start looking at the fundamentals of the oil market. Is it oversupplied or undersupplied? Because that's going to determine the direction.
What about these MLPs?
So a lot of those have the same story built into them, and so you just have to be aware that, in particular, the MLPs that are built around the shale plays, these have a very different dynamic than people are used to. One, because everybody knows the shale wells obviously deplete very quickly, but the second thing is that it's the maintenance portion of keeping those shale wells running is a lot higher than they are on traditional wells. And there's a simple reason for that. You have to insert a very, very long rod down this 10,000 foot deep well that takes a corner, goes another 10,000 feet, and that's going to be pumping out the oil after it goes through its initial decline. Those things require a lot of ongoing service. So people need to understand and dig in and understand what the capex and maintenance requirements are for those MLPs. They're different than the MLPs that were formed around what we call conventional oil wells.
Okay, all right. Just any projections maybe for crude oil prices? I mean, we're falling out of bed here, 58.76. Let's take a look and see. I know they do the rolling contract, so it makes it a little hard to determine the lows of the move here, but I'm just doing basis the front month contract here. We got down to 46.79 right now. That's going basis the August contract. I mean, 46.79. You see that? You see the 30s, the 20s. What based on the oversupply situations. Give us a target on the downside.
Well, the target downside is probably about the lows where they are. I'm only looking for this to persist for maybe another year or so. Again, the three big moving pieces here are you have your supply, your demand. The demand, of course, depends on the economy. Is that going to really take off here? If we get into another shock, if China really has a shock, or if the Greek pin actually bursts a bubble and gives us another 2008 style shock, pick a number for the lows. 30s doesn't matter. But if the economy continues to trundle along, and if it picks up, a year or two from now, we run into supply problems because the vast amount of capex that has not been spent by the international oil companies on all those very expensive deep water and other unconventional plays, which form the bulk of all the new oil that's coming out of the ground across the globe. So I'm looking for these low prices to persist. I'm looking for a retest of the recent lows, which is in the low 40s. And in a year or two, I'm looking for a recovery because oil has to at least cost the marginal cost of production. That's at least $80 a barrel right now in this world.
Wow. Okay. Chris Martenson, economic researcher and futurist, touching on the market, crude oil market in particular. Great information, Chris. Thanks for coming on. We'll have you on again soon.
Thank you, Joel.